right, so this last week, Tesla, which has been a very big focal point of a lot of our conversations, as well as NEO, Tesla just became more valuable than Berkshire Hathaway. Elon Musk became the second richest person in the world, surpassing Bill Gates. This is now, the net worth part doesn't bother me as much because that's all manipulation on who owns how many shares, etc. It's more of these two companies, polar opposite companies, and one has surpassed the other. What I want to do here is I want to show you guys the financials of each company. Now, before we go further, every Tesla lover and everything money hater is going to tell me I don't get Tesla. It's a technology company. It's not a car company. It has tons of growth. What are the other things I've heard? Those are the big ones. You're not factoring in this year's numbers, even though I am. All these things, and I just don't get it. It's the stock is going to keep going higher. Fundamentals don't matter. To those who say fundamentals don't matter, the company's currently market cap is $550 billion, which means if you want to buy every share outstanding, basically buy the whole company, you're going to pay $550 billion. We won't get into that as much. I said to somebody on our chat the other day, if fundamentals don't matter, what about $2 trillion valuation? They said, well, that's ridiculous. And I was like, well, wait a second. How is $2 trillion ridiculous? Because fundamentals don't matter, but $550 billion is okay. The same people who, when the company was $50 billion, would have said $500 billion was insane because it's 10 times larger. This is the whole point I'm trying to make. Fundamentals do matter, and fundamentals matter to everybody. It's just that when you're buying based on speculation and hopes that somebody else buys the shares from you at a higher price, you have to only rely, you're always going to say that today's price is justified and there's future growth in it. You are programmed to believe that. Are you wrong? No, to a certain level. Your process is wrong, but your hopes are correct. The company has a lot of growth potential. It will be bigger. But I want to remind everybody, Amazon has been wildly successful. In December of 1999, Amazon sold for $107 per share. 18 months later, it was down to $6 per share. And Amazon survived. It fell 94%, and it was one of the ones that survived. And now is worth $3,000. For those of you out there who say, look, it worked, but how many did not work? How many went from $100 a share down to zero? Hundreds and hundreds. The vast majority went to zero or got bought out for pennies on the dollar. That's what you got to remember. So back to Tesla and Berkshire. This is what I want to get to. Let's start with Tesla first. So Tesla, as we can see right here, 5-year chart. Look at this 5-year chart. Parabolic completely. Like I said, $550 billion market cap. Okay? PE ratio. Look at this PE ratio, guys. 1,165. That means for every dollar in profit, you're paying $1,165 for it. The historical average for the stock market is 15 or 16. Not 15 or 1600, 15 or 16. This is 900 times larger, 800 times larger than the historical average. Now, does that mean it's bad? No, it still has a lot of growth potential. And when you don't make a lot of money and you make very little money, that P is going to be driven higher. That in and of itself is not a reason to not buy Tesla. It's looking at the whole story. Let's look at their profit margin. For people who tell me that they're a technology company, find me another technology company that's a good technology company that's growing that has a 4% profit margin in the last quarter. Not only that, guys, I believe that 4% is because of their government 7% subsidy that they get. That's the only reason they made money. That goes away now. They have run out of that subsidy. They've run out of that whole rebate that they're getting from the government. The other thing, gross profit margin. Guys, Google and Microsoft have like 50 to 70% gross profit margin. This is 23%. This is not a technology company. This is a car company. Other car companies have between 15 and 20%. Now remember, this 23.5% includes that 7% that the government's giving them. Okay? So really taking that out, you're right in the heart of a car company. So, looks like a duck, talks like a duck, walks like a duck, must be a duck. I don't want to hear this thing about this technology company when they're not even making money like a technology company. Forget about the profit margin overall. Delete that. Just look at their gross margin. Take out the 7%, and they're at 16.5%. That is not a technology company. This screams car company. This is a car company, guys. So, right here, right now, I've already making the case for why Tesla is not worth it. Let's go to the financial statements. Oh, actually, you know what? Before we go further, let's go to Berkshire Hathaway and compare apples to apples. So remember, market cap 550 billion, PE 1165, profit margin 23. Look at their revenue, by the way. Their revenue here, 28 billion for Tesla, and their profit in the last year, 550 million. Okay? So in the last year, they've made about 2% profit. 28 billion in revenue, 550 million in profit. Let's go to Berkshire Hathaway. Okay. $540 billion market cap. So $10 billion less than Tesla, right? Oops, sorry guys. $10 billion less than Tesla, right? Okay, PE, 15, about the market. Gross profit, 31.86 versus 3%. Now, they don't have a gross margin in there because they have so many different companies, so many different intricate things that don't worry about their gross margin. Revenue, 280 billion versus 28 billion. Was it 28 billion? Yep, 28. So 10 times larger. Berkshire Hathaway has 10 times more revenue. Even better, net income in the last year, $35 billion. That is 70 times bigger. 70 times bigger than Tesla. So, if you had $550 billion lying around, would you buy a diversified holding company of 90 companies in full, plus a bunch of stocks and a bunch of cash flow, making $35 billion a year? Or would you buy Tesla? Remember, guys, what car companies even make $35 billion a year? And stop telling me it's a technology business, because even technology business, does Microsoft make $35 billion? Microsoft makes like $40 billion a year. So even technology business-wise, what would Tesla have to go to even make that? Okay, so that's what I'm sitting there saying. So when we're comparing Berkshire to Tesla, and you sit there and tell me fundamentals don't matter, growth matters, but you're paying higher prices for the company you want Tesla to become. You're already, let's say Tesla could even hit this. Let's say hypothetically Tesla could make $35 billion. You're paying for Tesla today what it needs to go spend the next 20 years trying to do, or the next 10 years trying to do, or the next 30 years trying to do. You're paying for it today. That's like saying, I've always said I'm gonna be a billionaire someday. Math is gonna prove it. Does that mean you guys should just call me a billionaire right now? Does that mean you should just go buy everything? Because my businesses can go do X, Y, and Z, you should go buy the product from? No, let me prove it first. Do I go spend like I'm a billionaire? No, because I'm not a billionaire yet. Same thing here. Why are we giving Tesla the benefit of the doubt when they haven't even done it yet? And they've had issues. I think 2 or 3 times in the last 2 years, Elon Musk has admitted that they were 2 weeks away from bankruptcy on multiple occasions. This is what I'm trying to get at when people say fundamentals don't matter. People say fundamentals don't matter. You know who they are? People don't understand fundamentals. But yet those same people would brag about the car they went and bought at a good price at the dealership because they negotiated hard, or the research they did to find this car or this good deal. But you're not doing research on stocks. I don't get that very much. That's what confuses me. We have a company making $35 billion a year, selling for less than a company that makes $550 million a year, because the company that makes $550 a year has more potential. Well, I have more potential than Tesla, don't I? So make me worth $500 billion. If I go public today, I have more potential of growth, right? Correct? I'm a smaller business. I have more potential for growth. My business does 15 or 20 million a year in revenue. I'm much more likely to grow 100 times than Tesla is. Tesla does 28 billion in revenue. They're not going to go to 2.8 trillion in revenue anytime soon. I have more potential. Make me worth 500 billion. Does that make any sense? And you might sit there and say it's different. It's not different. It's exactly the same thing. Fundamentals do matter. In the short run, stock prices can do whatever they want. But in the long run, if you're buying at these values, you are crazy. That is absolutely insane. This is the big difference between Tesla and Berkshire. And yet the market's telling us, and you know what's going to end up happening? At some point in the future, we're going to look back at this time and say, well, of course the market was overpriced. Tesla was worth more than Berkshire Hathaway. Obvious. And I'm going to say, you idiots. It was obvious to me, and it's obvious to everybody else in hindsight. Can I be wrong? Absolutely. Tesla's gone up 5 times. What's the number this year? Let's look at Tesla this year to date. Look at Tesla this year to date. This is crazy. This is freaking insane. It went from $83 a share to $570. That's 7 times growth. 7 times growth. Does Berkshire do that? No, that's what you guys are excited about. You see 7 times growth and go, this is it. This is awesome. But guys, what's going to make it worth 7 times more? If it's worth 7 times more, that's $3.5 trillion company. the biggest companies in the world right now. Let's go run a screener right now. What we're going to do is we're going to find the biggest companies in the world by market cap, and we're going to determine stock screener in the US, modify S&P 500. We're going to go to indices, S&P 500. Actually, let's go to the Russell 3000. Submit.
What is the Russell 3000?
Russell 3000 is 3,000 companies that are considered part of the market. It's a very good index for a wide range of for companies. And I'll show you exactly what I mean by this when I show you guys. Add filter. I could go rank. Market cap. Top 3,000. Submit. Market cap. Ready, guys? They range in size from 39 million is the smallest up to $2 trillion. So here's Tesla. Tesla's number 7? No, 6. Tesla's number 6. Tesla's number 6. Apple, Microsoft, Amazon, Google, Facebook. These guys all make a ton of money. Tesla makes the least amount and they have the biggest problems. Now, look at Apple, look at Amazon. I was a big negative on Amazon. I started shorting Amazon at $300 a share. I was wrong on Amazon, but not because the stock went up. Because in the time it took for my thesis to play out, Amazon's stock value went up higher. I think Amazon's worth between 600 and 1,000 on a 500-foot view. It's too wide of a range. It's only because I did it off the cuff. The whole point is I was wrong for that reason. Not because Amazon's selling at 3,100. That doesn't mean, or 3,300, whatever it's at. That doesn't make me wrong. It's this that makes me wrong. My whole entire analysis said, Paul, you started shorting at 300. It's worth between 600 and 1,000. You were wrong. But look at all these companies. You're telling me right here. Look at all these companies below Tesla. Look at these brands below Tesla. Visa, Walmart, Johnson & Johnson, JP Morgan Chase, Procter & Gamble, MasterCard, NVIDIA, United Health Group, all of Berkshire Hathaway are all below Tesla. Guys, let's go look at $100 billion companies. I'd rather have $500 billion companies. Let's look at this. Let's look at which $500 billion companies you'd rather own. Why can't I go further? Oh, yeah, right here. Right here. Let's do this. This is incredible. I would rather own these companies right here. Look, BlackRock, one of the biggest investment houses in the world. AMD, one of the biggest, now the new big Intel fighter. Lockheed Martin, American Tower Corp. I don't even know what ServiceNow is. Forget about those ones. Let's go to the next 5. Would you rather own 3M, American Express, I wouldn't want to own Square, Caterpillar, Charles Schwab, and Intuit. Those 5 companies are less than all of Tesla. You can have all 5 of these companies or Tesla. You pick. Come on, this is ridiculous. This is what I'm sitting there saying. You're going to fight me, and the comments are going to be, Paul, you don't get it. It's technology. Fine, I don't get it. I'm stupid. I'd rather own 5 awesome companies than one company that needs to hit every single assumption in the world to even justify today's value. That is the problem we have. So, if you have any comments, please say them below. I'm sure you'll have plenty of negative comments to me and tell me why I'm an idiot and why I'm stupid. I'm fine with that. Just come to me with fundamental questions, fundamental comments, and we'll get from there. If you're just sitting there buying it based on somebody else paying you more money in the future, that is called the greater fool theory. A greater fool will pay me for my shares at a higher price than I did. Actually, before we go, I do want to show this one thing. I do want to show that Amazon chart I was talking about. I want to show Amazon because this is so important to show all these companies that are awesome today, that if we sat there and looked and went to 1998 to 2003. Look at Amazon stock price. You ready? This price up here is 107. This down here is 6, all within a year and a half. And Amazon made it. And then another year and a half later, it's at 60. This happens. Pick another company out. Let's go to Cisco. Let's go to Oracle. Oracle is a big company. Oracle is a huge company. We were just talking about Oracle earlier. Let's go to Oracle. Actually, you know what I should have done? Let's do 1998 to 2003. Look at Oracle. Oracle went from a high of $46 to a low of $8. So 46, 8. How How much of a drop is that? That's an 85% drop. And Oracle was making tons of money back then. That wasn't even that company had been around since the 80s. It started in the 70s or 80s and went public in the 80s. This is what I'm saying, guys. These companies can still do well. What's Oracle now? Oracle's huge now. They went to a low of 8 and now 56 bucks. They've barely even beaten their 2000 high. So when I hear people tell me like, Paul, it might drop 10 or 20%. No, it will drop much further than that. 100% guaranteed it'll drop much further than that. You're not getting a 10 or 12 or 20% pullback in Tesla. When a pullback happens, a real one, it is going to be devastating. If you think you're going to sell faster than everybody else, you are wrong. You know why? Because the second, you'd have been the guy who didn't sell. Oh, see, I was right. Look, it's rebounding. Blah. Don't worry, it'll come back. Blah. Don't worry, it'll come back. Blah. And you know what's going to happen? You're going to sell right about here. You know why? Because you are lemmings. You fell off the cliff, the lemming that fell off the cliff. That's all it is. I'm going to be insulting here. You're a lemming. If you believe you're going to be the first one off, you're going to stop from the cliff first, you're wrong. Unfortunately, this is what sucks. Middle class America is what gets hurt the most here. It's not rich people. Those rich people are the ones selling you the stock. If you ever think that you're the one that's buying, that some rich person is going to lose, but come on, you're the rich person. You're the person who's buying the company, the stock off the rich investment bankers. Their job is to sell to you. They sell hopes and dreams. They don't sell fundamentals. They sell hopes and dreams, and it works like crazy. Hook, line, and sinker. That's all I have to say.